Hey, everybody. Thank you for having me back, David, and I appreciate all of you. Listen, I was so excited that David was having this event around indicators because here at Trading Trainer, we have released some free indicators as well as some indicators that are for pay. But one of the things that I'm going to be doing today is making sure you have a way to get our free indicators. So all you have to do is kind of listen through some of my presentation, which is going to be quite educational. So I'm going to ask you to make sure you have, if you're taking notes the way I take them, make sure you have a few sheets of paper and a pen or a pencil. If you're feeling confident, go for that pen. And if you're taking them electronically, be ready to take a few notes here because I'm going to be talking about not only my indicator and my other tools, but also my strategy, which applies to this indicator for, overcoming this trading trap that's been happening. Because I actually absolutely love these sideways choppy markets that are starting to develop during these summer doldrums. And the reason is because I sell options premium, and I'm going to give you a kind of a primer on that, as well as, like I said, I'm going to give you a link to download my free indicators, and I want you to take advantage of those. So with that also said, I want to get you to give me a little bit of patience because this is the first time I'm kind of going through this version of my presentation. So I'm going to watch the clock really carefully, and I may have to abbreviate some parts of my presentation because I don't quite know the timing like I usually do. So let's get right into it. I'm already sharing my screen. You can see it right here. Let's get into it and talk about a couple of facts out there right now. First of all, there's really a lot of uncertainty going on right now in the world. I mean, we've got skirmishes all over the world. We've got crazy politicking all over the world, especially here in the States, but there's other places in the world that's got some crazy politicking. But the scoop is some of that is manifesting itself in the markets in weird ways because the markets are less of about engineering and math and science and more about it's a huge psychology experiment in tribe think, right? So what's happening in the markets, if you can play it right, it really can set you up for months, if not years to come. And this is one of the reasons why I'm very much interested and have been interested for the last quarter century in option strategies because option strategies allow you to really take advantage of whatever the market can throw at you. It's just a matter of identifying what the market's throwing at you and then picking out of your options tool chest what sort of strategies to go ahead and match the patterns that you're recognizing. One thing you have to really understand is that despite what the talking heads say to us, money is not created or destroyed in the markets, right? I've heard talking heads over and over, wow, trillions of dollars disappeared in the markets today. That's not actually true. Markets are where money changes hands. It simply goes from one hand to the other. And so the scoop is being able to understand where the money's flowing and putting yourself on the right side of that equation, the correct side of that equation. That's what we're going to talk about today. So before I always get started, I always like to understand my audience and who you guys are. I haven't been with you guys since I think November of last year. So are you here because you actually want to learn how to invest for low risks, high returns? Basically, learn how to fish and be 100% self-reliant? Or are you, and I want you to be honest, are you here to invest and have actually not only learn, but also be around seasoned investors that'll review your investments before you make them? In other words, be a fisherman, but be around other expert fishermen that'll be there to help you. Or are you looking to just follow seasoned investors and see what they're doing in their portfolio so you can go ahead and be a fisherman who fishes along other fishermen and do what they do? Or are you here for some other reason? Let me know in the chat. Just give me a B, C, or D. I'm just curious. and I'll let the answers roll in, but I'm going to keep going because, again, I'm not sure of the timing. Hey, listen, I'd love for you to like imprint in your little minds here what the heck is going on in this particular chart. And I'm going to come back and revisit it, but a couple things I'd like you to notice. Um, this is my zero line right here. And I want you to notice that I've got this range low and this range high, and the range low gets above the zero line very quickly between the 1 and the 2, right from the get-go, and then is above that zero line the whole time. And it goes parabolically or exponentially rather than linearly. And I'd like you to pay attention to that because we're going to talk about that more. But that's kind of how this premium selling strategy that I just absolutely love doing, and how I'm going to give you some indicators to help you really slant the reward versus risk towards the reward side, minimizing the risk. I'm going to be talking about that today, but I want you to kind of get this in your head because I'm going to wind up showing you some trades that actually follow this pattern. So I want to reverse engineer some of the thoughts because I know folks are sometimes talking about trades where, they're talking about like doubling their money in a couple of days or in a day trading environment. And, they talk about those winners, but they often gloss over the number of losers they get in order to get that one winner. And so, what I like to do is a more predictable type of investing or active trading or active investing, which is, count on a more reliable variable that is very predictable. And so I don't go, there are times where I get those big wins as well, but my big thing is to create consistency. So my focus is, I've reversed engineered how to double my money in a year, right? Which is way better than just putting your money in a mutual fund or even giving it, to a high flying ETF or something like that. I plan, and I always talk about people who come to me for investments. I'm like, if you can beat doubling my money in a year, I'll gladly give you money. Otherwise, I'm going to keep it in the markets and do what I know how to do best. In order to double your investment every year, and this is just simple interest, you really need to focus on 6% trades, right? Trades where you gain 6% in a month's time. And that's something that my folks at my program do all the time. In fact, a lot of times our monthly growth is greater than 6%. Like we aim for the moon, but oftentimes we get the stars. Low double digits per month. And that means instead of doubling your money every year, we double it about every 5 or 6 months. But our goal at a minimum, our worst case scenario is doubling our money every year. So if you have $1,000 portfolio, which a lot of times with options trading, $1,000 is enough to get started, that's 2,000, just over $2,000 in 12 months. And in 2 years, you're talking about over $4,000. In 5 years, close to $33,000. And in 10 years, you're talking about being a millionaire, right? Just starting with that $1,000 investment. And this is very similar to what I started doing in 2003 with an experiment I ran. Some of you who know of me know that about that experiment. That portfolio, which I haven't ever taken any money from at this point, is in an 8-figure number. So it's very cool what this happens. And just to give you a little bit of reference, when I was a kid, which was in the 1970s, because I'm 51 years old, when I was a kid, you'd hear on TV about being a millionaire, and that was a big deal. But now, millionaires are a dime a dozen. The key to really get yourself set and get your family set is to focus on that $10 million number. The thing I like about my strategy as well is once your portfolio is around $100,000, you can then, I always recommend that folks who have small portfolios, do what you're doing and let your portfolio grow to at least $100,000. Because then if you start taking a dividend from it, $100,000 portfolio can potentially generate over $100,000 per year just by selling premium. And that's kind of fantastic knowing that, the median income of a salary job, a white collar job where somebody's putting in 60 hours a week of their time is $87,000. Now, I know if you're on the right or the left coast of the United States, you're making a lot more than $87,000. But if you factor in the whole United States, that's the median salaried position. And so just letting your money work for you by selling premium, you can totally, beat that number once you grow to your portfolio to a certain extent. So I always say, make sure, if you're doing any sort of active investing like this, that, it's money that you can afford to lose. That's number one. But number two, let that money parlay, do whatever you're doing, until that money hits a critical mass. So what was it that we're actually investing in? What is this indicator going to be supporting? It's called selling theta decay optimized option premium. And you're probably saying, AJ, what the frick is all of this word salad that you just threw at me? So let me break it down. Basically, we're profiting on time passing by. That's one of the variables that influence option price. A lot of times when people think about equity options, they're thinking about how to leverage an underlying symbol like a stock, an index, an ETF. There's actually options on all sorts of securities these days. How to leverage that directional move. And that is one component of an options price, but there's other components like the fear or confidence in the market that affects options price, and also time passing by. These things are wasting assets. But time, if you think about all those variables, like the underlying symbol price, whether there's fear or confidence in the market, and time passing by, of those three variables, and there's a few more that influence option prices, but of those three variables, which is the most predictable and the consistent? Time passing by. Like, if a minute wasn't a minute, if an hour isn't an hour, if there isn't 24 hours in a day, 7 days in a week, 52 weeks in a year, if that all of a sudden changed on us, I think you and I would be worried about a lot more than just our investment dollars growing, because basically that would mean that things are topsy-turvy in the world, right? So time, very consistent. Like when I look at the calendar and I see the third Friday of the month, I know that that's going to come in a predictable amount of time. I can count how many days until the third Friday of every month, right? So if that's my my primary profit mechanism, that's kind of cool, right? It's time. So just as a review, let me know if you're paying attention. What have I said so far? And by the way, my questions are going to get, just like that curve I showed you, they're going to get exponentially more complicated. But I'm going to start easy here on you. I want to know, what minimum returns did I say I have to focus on monthly in order to double my portfolio annually? 0.5%, 1.5%, 5, 6, or 10. And you can go back after this presentation and check my numbers, but it's what? A, B, C, D, or E? We'll see who's kind of paying attention here. If you said D or 6%, you're spot on, right? That's exactly what I said. So thank you for paying attention. And if you didn't say it, write down that little note now so that you have that information. That's our topic. Now, always when I bring up options, somebody comes up to me say, aren't these things risky? Well, again, if you think about the underlying asset of an option, right? Because an option is a derivative. You're talking about, if we're talking to equity options, you're talking about stocks, indexes, ETFs, right? And if you trade stocks, indexes, or ETFs, or even for that matter, commodities, or even foreign exchange currencies, things like that, you pretty much make money by buying low, selling high. In the equities markets, if you're kind of elegant there, you know how to short things, so you know how to make money by selling high and then buying back low, right? So you can make money on something that's dropping in price. But the beautiful part about options is we can make money also not only in those two instances, but also if something gets stuck in a sideways channel, which if you look at a lot of symbols, that's where they stay most of the time, right? So instead of trying to time ourselves on an up move or a down move, looking at the S&P 500 equal weighting recently, versus, the Magnificent Seven there, or even the Microsoft, Apple, Nvidia. There's been a record-breaking divergence of the top three stocks and the rest of the S&P 500. Rest of the S&P 500 since about the end of April has been trending sideways. So options allow you to profit on a sideways channeling symbol, which is great. Also, options profit on time passing by. That's what I like. Also, options profit on fear. You can also profit on confidence in individual securities or even in the broad market with options. In fact, last time mathematicians took a look, there was 27 different ways to profit with derivatives like options, combining them differently, but also just selecting different options. A lot of people don't realize this, but the expiration date and the strike price that you pick for your option change the ways that it behaves considerably, right? And at the money, near term option behaves completely different than an out of the money 3 to 6 month expiration date, or even a deep in the money, 8-month expiration date. They're three different assets despite being all call or put options. So it's not just type of options, it's the selection. But what's beautiful is that no matter what the market's doing, so long as I've got a good scope on what the pattern is in the market, I can go back and pick an option strategy that'll profit on it. I don't have to screen and pick and choose that perfect, stock and then time it, maybe have to time it like in the middle of my workday or something like that in order to take advantage of the move. Instead, I just, pattern fit the right strategy to the right ticker, and it let it go, right? And that's what I do. So I like the fact that I have more than one or two strategies in my back pocket. I'm not just trying to buy low, sell high, or trying to, short things. I've got 27 different strategies to choose from. Now that brings up, for some of you folks who are focused on different types of investing, you might be saying, well, I still don't understand what this option is. It's a financial instrument called a derivative, but brought down to kind of like, everyday speak. These things are typically used to hedge risk. They're bought and sold to hedge risk. These big market movers, pension fund, mutual fund, hedge fund traders, they use them to hedge risk against stocks, indexes, and ETFs. But what we're doing in our premium selling program, and what you can do just as easily, is sell their premium to generate really consistent income. So just as an aside, and I'm watching that clock because I want to show you my indicator, so stay tuned. But do you guys, just with a quick in the chat, I'm looking over here on my other screen at the chat, do you guys know about who I am? Because if so, I'll just fast forward through these slides where I give you a little brief intro on who I am. Let me know in the chat. I'll keep coming and looking back over here. But just really quick, I've got all these assets out on the internet, right? You can check out my YouTube. You can check, I got hundreds of videos. In fact, I've got a YouTube show every Friday morning at 11 a.m. Eastern time that you may want to tune into. It's called, get this, it's called the AJ Brown Show. We just talk about, the markets. I got podcasts, Facebook. They don't call this Twitter anymore. They call it X. I've written so many articles. You can go see all my articles here. White papers up the wazoo. I'm big at contributing into the white papers. I've been doing this since 2005. I've known David since Hammer was a hatchet, and Anka as well. You can get a hold of me right here. You can even call me. That's my phone number, right? And by the way, if you go visit any of my assets out on the internet, please go ahead and subscribe to them. It'll make those algorithms get my name out there even more so that people can learn from all my stuff out there. Founded a company called Trading Trainer. recognized as the world's most disciplined option trader. Actually, I think behind my back, my peers think I'm the most laziest option trader. I like to think of myself as the most efficient option trader because I do things after I have a toddler. Yeah, get that. I'm 51 years old and I have a toddler. Uh, I wait until my toddler goes to bed and all of my stuff is end of day. So at 10 p.m. Eastern time, I'm in front of the computer and I like to be, for me, it's a destination. It's a way to keep the ATM machine rolling, right? I go in at 10 p.m. I'm done by 11 p.m. and I set up my trade bots during the day. And during the day, all I do is play with my toddler, right? So I'm very efficient and I like to minimize my risk and maximize my reward. But I also never like to go to bed afraid of what's going to happen when the market opens the next day. I hate white knuckling trades. So, that's not my way. And if that resonates with you, or if you've got something during the day as important as I do, like a job or a toddler or your family, and this is the way you want to trade, this may be interesting to you. I've been doing this stuff since 1997. Uh, the Trading Trainer, I've been publishing my daily insights every day since 2002. I wrote this ebook in 2005, which most successful ops traders, if you go on their computer, you'll find that ebook. Home study course in 2008, that again, you'll see on very successful traders' bookshelves. And, I started in 1997 after getting a whole bunch of degrees, right? I have mechanical engineering degrees, I've got electrical engineering degrees, I've got master's degrees, and then I never used any of it, right? Professionally. I do it for fun, but it's definitely not been a destination for me. It's more about the journey. I also have a strong background in commercial business and investing. Um, and in the last 15 years, I've really been focusing on how to be a great teacher, right? Especially a teacher for grown-ups, right? Because our minds are not as plastic as other people's minds. And so there's a whole, discipline called accelerating learning methods and techniques that I've been really focusing on because I really like to convey my insights to people in a way that they can actually, use them. And so using the methods that we used when we were kids in school doesn't work anymore for you and I. I don't know if you found the same way, but I know that works for me. And just know when I first started doing this in the first year, not only did I spend $27,000 on seminars just for that first year, I spent pretty much the same amount adjusted for inflation every year still, because I'm still always a learner. But this was in 1997, and thankfully I didn't have a family then, and I had a pretty good job at Hewlett Packard, so I was earning very good, living in Silicon Valley, and so I had the money to spend because I was living with a bunch of guys. I didn't have a mortgage payment. I didn't have a family, so I could spend this money, but and back then, there were some people experimenting with WebEx, but doing these things on the web was not happening. You actually had to go, this might resonate with some of you. You had to go to a hotel on a Saturday and spend a half a day, and then somehow you'd wind up spending money and you'd come for all day Sunday, and the next thing you know, you spent another big chunk of money and you were on an airplane going for like a 3-day intensive somewhere. That's kind of the business model back then. So I spent 27K on seminars, but then I tried to do what they taught me, and I wound up giving $85,000 back to the markets, making really stupid investments. I don't know if you guys can resonate with that. That was more than my 3 degrees in university had cost me in the early 90s. I just figured at that point it was like another university degree. And I want to give you some insights. Again, I'm watching the clock. Here's 4 things I learned, 4 shortcuts if you're struggling to be successful at this active investing or trading thing. Here, take these notes. Number 1, stop chasing shiny objects. Really figure out, take inventory on what your lifestyle allows, right? I had a 9 to 5 job and I had kind of a very active, finally settling down in my 50s and having a family. You can probably imagine I was quite active with my personal life and with some business things, as well as being a pretty big high executive at Hewlett Packard. So I had to say, listen, I can't be a day trader and I can't time things because I'm going to be in meetings or I'm going to be, out at the bar drinking. I can't be up, doing Forex trades. So take inventory of what you can actually do in the present, not what you might be able to do in your dream life, but what you can do right now, and then settle on one type of investing and really learn it well, master it. Don't jump from whoever's trying to impress you with their message, right? For me, options trading made sense because you set up these strategies and then you let them run. So that's what I focused on learning. I dabbled in all the other stuff, but it just didn't work with my lifestyle. Settle on one thing that resonates with you, that works with you, learn it well. That's number one. Number two, hire a mentor who is currently doing what you want to do and knows how to teach. You have no idea how much money I have spent on coaches who obviously they show me on their screen in live trading sessions what the F they're doing, but they can't teach it to me. They can't convey the knowledge. So, and this is, in nerd speak, this is saying learn from guided discovery versus trial and error. Trial and error is a great way to learn, but it's long and it's expensive. If you can learn by guided discovery, that's going to shortcut your path to success. Number three, join an investment group, right? And not only join the investment group because you have camaraderie, although that's quite valuable, but also, and I learned this at Hewlett Packard, at Hewlett Packard, when Epson or Canon would put out a new printer, you know what we would do? The engineers would do? We would buy that printer, we would take it all apart, we would find one thing or two things that we can incrementally improve, and then we would re-release it, right, as our product. It's called leveraging with pride. And here's one of those cases where I disagree with the school systems that I'm about to put my toddler in, because they teach you that cheating is not okay. And it's not really cheating, it's incrementally improving. You should look over somebody's shoulder. You should take what they're doing, and then you should make it better, right? It's called leveraging with pride, and you should totally do it. If you're in an investment group and Bob or Sandy is doing a trade that looks pretty phenomenal, do that trade too. Don't be dumb, right? It's not proprietary. Do that trade too. And if you can do it better, do that. If you can apply a different strategy and make more money on it, do that and then share your results, right? So people can leverage with pride off. That's how we progress as society, folks. And finally, surround yourself with like-minded investors, right? When I started this, I was a loner. My family, bunch of Italian immigrants, they totally, believed in working and trading their time for money, which is great, right? I don't slight any of them, but they kind of, kept telling me that being an investor and making a full-time career out of investing. And by the way, I started investing in 1997. I didn't leave my job at trading at Hewlett Packard till 2005. Remember, grow your portfolio to a certain number, a critical mass, before you start taking money off of it to live. That's always been my philosophy, and you should do the same. But surround yourself who are going to celebrate your wins, but also tell you that everything's going to keep working if you stick to it with your losses, right? Because I had my family in my ear telling me how insane I was. And every time I would, have a losing trade, they'd say, I told you so. And it was really a negative drag on me. And if it wasn't for me getting in with folks and then, telling my family, I'm like, that's why you work hour to hour. This is exactly what I did. So I hope you got even a tidbit out of that, right? Either reinforcing what you know already or giving you some tidbits. But this is how I shortcutted my way to becoming a successful investor and trader. Last but not least, I started a foundation. I started this in 2003. I take historically underserved inner city kids off the street. I teach them how to invest. In short, I started with these 9 people who are in this picture. Actually, not all of them are in that picture. That was in 2003. These guys have gone off. One of them's a professor at Denver University. They all went off. And here's the scoop. We didn't even have high-speed internet. We had to go to a public library. And at that time, DSL, do you guys remember DSL lines? The library had DSL, digital subscriber lines. And so, and they limited people on the computer to just 30 minutes. So we had to do what we wanted to do in 30 minutes. I worked with these kids for 6 months. And at the end of the 6 months, I gave them each $2,000 of my own money, thinking I'd never see that again. And I'll tell you, every single one of those kids paid me back my $2,000. And, they went on to buy their own computers and get their own DSL lines. Like I said, one of them's a professor now. One of them's a coach working for me. They're all doing very well. And I've done that year over year. In fact, since then, we've moved it from, the Denver to Chicago. There's a lot of historically underserved inner city kids in Chicago. We're partnered with the CBOE. Last year, we graduated after taking a break during the pandemic. Last year, we graduated I think it was 123 kids. So just wanted to put that out there. That's why I do this, because, if I know that these kids can do it, I know you can do it too. So back to this whole discussion on premium and where the indicators play in. We focus on 4 simple strategies, right? Simple transactions. Writing covered calls is probably the most basic. Writing covered puts. This one, by the way, I'm not going to be talking about this one much today, but you should write this down and you should go research it on your own, or come back to me offline and I'll talk to you about covered puts. This is flipping the covered call upside down. And, with what looks like is going to be happening in the markets, whether you're looking at like level 4 NASDAQ data, or whether you're looking at some of past historical stuff, with looks like is going to happen probably for the last half of 2024 and probably into 2025, you'd want to have this strategy in your back pocket. Also, we like to write covered calls against leaps, right? I call it supercharging our covered call writing. And for those of you out there that have a little bit of an options vernacular, kind of academic, this is a version of bull call diagonal debit spreads that we like to do. We also like to take that covered put and supercharge it as well. And for you academics out there, that's a bear put diagonal debit spread. So those 4 strategies are kind of what I focus on a lot. And just as a note, you might want to put asterisks or something by covered calls, the bull call diagonal debit spreads, and the bear put diagonal debit spreads. These are cash trades that you can actually do in a retirement account, and that's great for your tax implications. This guy over here, the covered puts, he does require a margin account, and so that's something you need to know. You need to have your margin account in force there. And just so you know, if you don't have a margin account, you only have a cash account, the corollary that is a cash trade is this guy over here. So even if you can't do these, you can do these, and they have the same effect, right? Cool. I hope you got those written down. Now, a lot of people are saying, okay, you keep mentioning option premium. Just know that when you look at an option price that goes up and down, right, there's the in the money value, and then there's another component called the premium value. Sometimes you'll hear that called the time value. I don't like that name. That's because there's a lot more loaded into that component of the option price than just time. But you'll hear it called time value. You also hear them called intrinsic and extrinsic values. But just know this. When you look at that option price, like if I pull over my Thinkorswim, which is a great option trading platform, and you look like, for instance, we can just look at the spiders right now. You can see this thing's trading. Actually, the market closed at the beginning of my presentation, but you can watch as the various option prices move up and down during a live trading session, right? And those option prices consist of that in the money value and the premium value added together. So here's an example. This is when I was putting together this presentation. So this is a couple days old, but I pulled the price of Lyft, the end of day price of Lyft. It was $12.48. I think this was Monday's close. If I buy some shares of Lyft and then I immediately turn around and sell the next monthly option, which expires on August 16th, the 1250 call, right? I make $1.09. I get an instant dividend of 109. That's because options are sold in lots of 100. So an option share, you can't just buy one option share or sell one option share. You have to do it in lots of 100. So when I sell this option back, I get $109 back for every contract I sell. So I consider that an instant dividend. It's a very consistent, I can do that month in and month out and make this one-time payment. And it's one transaction per month, right? It acts as a discount, right? I bought that lift, but I immediately got a discount on it, a credit of $1.09 against that, right? That drops the price by almost 10%, a little less than 10%. That's great. It's like getting a sale. And this option, right, that we keep talking about, this thing acts like a expiring coupon. As we get closer to that expiration date, this value naturally drops down until it hits zero at the expiration date. So what's cool is if I capture this money up front, and just hold it, I get to capture that money. I get to keep that $1.09. So all of those components, the discount on the stock, the expiring coupon, the instant dividend, this is a great component of options that I'm basically making money on time passing by. So what happens if Lyft closes above $12.50 on August 16th when it expires? Well, okay, I spent $12.48 and I'm going to get exercised at $12.50. That means I'm going to make a 2-cent profit. Big deal, right? But I got to keep the $1.09 up front. So I walk away with $1.11. That's 9.7% ROI. Remember, my focus is 6% trades every month, right? So great. But that's not even my ideal case. My ideal case, in order to minimize my effort on this, is if it goes sideways. What happens if Lyft is flat by August 16? Okay, I spent $12.48 to get into this investment. I captured $1.09. It expired worthless, which meant I get to keep the $1.09. I've made 9.5% profit so far, and then I get to do it again and again. It's like renting out your stock for a month, and I get to collect these rents and keep doing it. So now you're getting to start to see how I generate these incomes. I find these boring ass stocks that are in sideways choppy channels, and I simply sell premium against them every month and let the timer go off, right? I'm really simplifying it, but that's basically what it does. I'll show you how to kind of automate this again with those free indicators I'm going to get you to go download. Now, of course, what happens if Lyft drops by August 16th? This is another interesting facet of this strategy, and that is with Lyft, I paid $12.48. I got that $1.09. That $1.09 actually reduces my break-even price to $11.40. So what's really cool about that, right, is that this strategy doesn't go into the red until the stock goes below $11.40. So I basically have a profit buffer. Now, in a few moments here, and I'm watching the clock, I'm going to show you how I reduce the risk on return even more with an active tactic. But just built in inherently into this strategy is that profit buffer. So that's kind of cool too. Now, before I go on, this is just taking some closing prices. As somebody said in the chat, they're like, most trading gurus are gurus of just charts. So sure, anybody can take an end of day, set of prices and create an example. So I always like to combine that with an actual trade where I did the same thing. So this is a trade, and I want you to see what I'm talking about. Ford likes to go sideways and choppy, right? Ford is it's actually a quite boring name, right? If you compare it to like an Nvidia or a Tesla. It's a company that it makes profit every quarter, right? It reports good earnings every quarter. And it also, every once in a while, likes to give a nice dividend to its investors. So it's one of those stocks that attracts, you can almost imagine the avatar of the investor of Ford. It's not like a young high flyer that's also interested in crypto and stuff like that who wants quick wins with Nvidia. No, this is somebody who wants the dividend. And that's one of the reasons why Ford just kind of goes in a sideways choppy pattern a lot of the time. So on January 29th this year, I bought some Ford stock. I bought 900 shares, 1154. And as you can see here, every month on February 16th, it looks like I skipped a month, April 9th, and then April 26th. I'm not doing like day trading. I'm doing like a strategically, and it doesn't matter really what time during the day. I basically set my trading bot to do the trade the next day. I wound up doing what? One, two, three, four, five trades against Ford until it was actually called out just July 19th. Notice, by the way, every time these options expire is the third Friday of the month. Third Friday of the month is payday for me. Now, you might be asking, hey, why did you pick February 16th? Why did you pick April 9th, April 26th, June 3rd, July 9th? That's where my indicator comes in handy. And like I said, I'm going to give you that URL to go download that in just a few seconds. But you can see that by the time I walked away from Ford on July 19th, so I was in this trade for about 6 months, I walked away with 30.4% ROI on that trade. And this is just the basic covered call writing strategy. We have ways to kind of speed that up a bit, but great trade, right? And that's a real trade. All right. So really quick, what does investing by selling premium create? Again, one of my just making sure you were paying attention questions. And I say answer all that apply. That means that there's more than one answer there. What do you think? A, B, C, or D? Instant dividend, discount on a security, a profit buffer at expiring coupon. If you think and said, well, I think he mentioned all of them, you're absolutely right. It was all of them. Tricky. Now, I'm going to start getting a little bit more in this, next 5 to 10 minutes. Hey, how can we lower our investment, increase our returns, and even convert something that would usually be a margin trade into a cash trade? What should we do? Should we A, sell out in time options? That means, options that don't just expire in the next 3 to 5 weeks. Should we replace the security with options trading at parity? Should we give up and buy mutual funds, or is this not even possible? What do you guys think? Let me see. For those of you that chose B, you're absolutely right. You're absolutely right. B is the answer. You don't want to sell farther out in time options, by the way. The juice isn't worth the squeeze. Remember, or you may not know this, but when you sell an option, you now have an obligation to perform. That's why we sell our options covered, because the covered part is what allows us to, take care of that obligation. But you really don't want to be under that obligation any more than you have to. And when I say the juice isn't worth the squeeze, if you go out in time, if you go from like a 3 to 5 week option to a 2-month option, like an 8-week option or farther, right? 10 weeks. If you go to a 10-week option, you don't get incrementally that much more profit. So it's not worth it. What you want to do is instead figure out how to lower your break-even price, how to lower your cost basis. And B is the answer. Write that down. So you might be saying, what the heck? What is this geek speak trading at parity? So what I've proven, I think, is that option premium is the most when we have options that are at the money. But if we go very deep in the money, it turns out we slant the option and it winds up having very little premium. In fact, we target less than 5%. And it turns out to be mostly this in the money or intrinsic value. What's all that geek speak mean? It means that if you choose a deep in the money option, it winds up acting just like the underlying security, right? So that if the stock goes up $1, so does the deep in the money option. If it goes down $1, so does the deep in the money option. The only difference is besides it moving dollar for dollar, it's at a much cheaper price. This is where leverage is incorporated, right? But now we're dealing with an option. So if you're going to use one of these substitute options, how far out in time should we go? Well, you saw with my Ford example that I was able to do about 5 months of selling premium against that Ford option, and that's actually where the bell curve is. Sometimes our trades go as much as 8 months. I mean, there are some outliers that go even more than 8 months, but 8 months is usually the cap. Some of them only go 2 or 3 months, right? It's actually a quite flat bell curve. I've been studying this for almost 2 decades, right, with over tens of thousands of people who've gone through my program, and I watch their trades. You want to make sure that that back month option being your covering position, that it doesn't expire while you're selling premium. And so we basically want to go far enough out in time so that we can sell that premium until it gets exercised or bailed out. So that number is at least 8 months out. Now, I like to use leap options. Leap options have a lot of liquidity. It's never bad to have options. These are the options that expire on the third Friday of every January. So there's a 2025 leap. It's January. I think I can even look on my option chain right here. I have a charting package up here in front of me. It is January 17th this year. There's even a 2026 option. The 2026 option, January 16th, 2026. And, usually if it's a typical option in September, we see the 2027 options appear, right? So usually I use these leaps because they have a lot of liquidity, but the main rule is to just go out 8 months, right? So let's see if I can get over here and get back into my presentation. Here's that lift example. So remember, we could buy lift for $12.48. This was the Monday end of day prices. Or I could substitute it with the lift option that expires next May. So almost 10 months from now, the $5 call. That thing is only at $7.60 a share. So instead of spending $12.48, I can have something that is moving just like Lyft, but for much cheaper. So, and just if you want to look at the statistics, the in the money component of that substitute option is almost 98.4% of its value, and the extrinsic value is only 1.6. So this is a great substitute option. So for instance, if I'm using this, I'll still sell that same option that I was talking about before, the one that's worth $1.09. I'll get that instant dividend. It'll do everything like it did before. It'll act as a discount. It'll be an expiring coupon, all of the above. If you run through the scenario, if Lyft closes above 1250 on August 16th, we get that exercised. And here's the neat part, right? If we get exercised between the 1250 and the $5, that's what makes this a diagonal spread, or the word spread. I get to get 750. I get the difference of those two strike prices. So if I get 750 for something I paid 760 for, you're probably saying, AJ, that doesn't make sense. That's a 10-cent loss. Don't forget I collected that $1.09, which means I walk away with 99 cents, but my break-even price was so much lower, it turns out creating a return on investment of 15.1%. That's way above that 6% number. But again, that's not my ideal case. My ideal case is if the stock goes sideways, I keep my $1.09. I have 16.7% ROI so far, and then I get to do it again and again and again. And of course, this has that profit buffer built in because I get that $1.09, credit up front. So my break-even price is $6.52. Pretty cool, right? Let me just show you. I'm going to speed this up because I see that I'm getting towards the end of my presentation time. Here, look at AT&T. Very similar situation to what we looked at Ford. I started this one on November 2023. I was out on June 21st. Let's see how many times I sold premium against Instead of the AT&T stock, I sold it against a $10 call. 1, 2, 3, 4, 5. It looks like I skipped April and May. 5 and ultimately 6. 6 times I sold premium and I walked away with 56% ROI. I mean, you can't get better than that, guys. That's fantastic for a trade that you only do December 10, January 8, February 2nd, March 22, not again until June 5. You're hardly maintaining these things, right? Focus on that 6%. Your money will double every year. If you can get more than 6%, absolutely fantastic. All right. How can we drastically reduce our risk on return? Should we do only half as much premium? Should we go farther out in time? I hope nobody answers that after me telling you that wasn't viable before. Maybe we should collar the investment by marrying a protective option? Or is what I'm talking about not even possible? Here's the answer. Let's collar that investment. We'll marry a protective option to it. So remember this graph? This graph is actually of almost like a textbook trade that I did. Let's see if I can pull it up. This was a textbook trade that actually went on for over 14 months. This is Pan American Silver. But here, check this out. I just want to go through some of these trades. I sold my premium, and on the same exact day, I bought a protective put. That premium expired worthless. So that means I got to keep the money. In this case, $1.76. And then I looked for my signal again using my special indicator. I looked for that signal to go ahead and now sell my insurance. I didn't need the insurance, the protective put anymore because my premium was gone. So not only did I make money on the selling of the premium, not only did I protect my trade, but I also made money because I strategically only buy and then roll out of my protective option when I need it, which is when I sell premium. So I turn this, most people buy protective options and they, cause a loss against the trade. They're an expense. I've timed it, right, with my indicator so that not only does my protective option create a protective situation when I have premium sold, when I need it most, but I also now get a second source of income every month. So $1.76 and over here $1.15, 2 sources of income. Next month I got $1.47. I bought my protective option for $3.01 and I sold it for $3.62. I got $1.47 and 61 cents. The next month after that, $1.50, and then I paid $1.20, and my protective option actually cashed out at $3.07. So every month I do these 2 trades on the same day, and then I just roll out of that protective option when I don't need it anymore, and I get ready to get the next one. But here's the other interesting piece about using a protective option. Look at this cost basis. So this is basically my break-even price. And you can see as I make income every month, my break-even price gets lower and lower. But look at my protective option strike price, $34. Notice that right after the first month I sold premium, it's no longer, my break-even price is no longer trading above $34. But yet I'm still protecting the position at $34. See, this is what I really like. People are always talking to me about, hey, what's your win-loss ratio? Well, the scoop is because I'm trading time, so long as I can keep the trade through one cycle of premium selling, there is no win-loss ratio, right? I'm guaranteed, even if the underlying symbol goes against me, to walk away with a profit. If you take a look at this trade, for instance, my break-even price is crossed between the first and the second selling of premium, right? The average time that we stay in our investments is 5 sellings of premium, 5 months. At 5 months, if my position got exercised, that means the stock went in my direction, I walk away with 65% ROI in this trade. This is an actual trade. This is the one on POS. But even if the stock goes against me in 5 months, I still walk away with 50% ROI. See, it's about time passing by, and it's not about what the underlying symbol does. Does that make sense? See, I just have to have this position last long enough that I'm protecting it, that I'm using either a stop loss order or a protective option that's going to protect it above my break-even price. And then the profit just accrues. It doesn't matter whether this stock goes for me or against my initial covering position. I'm still going to make money, right? I hope that resonates with you. That's why I like this. This is how long before my position becomes risk-free. So the question is what do we have when our cost basis, our break-even price, is now less than our protective bailout price? Is it a risk-free investment, a losing trade? Am I getting too complex with 2 trades a month? Ask a day trader who does like 8 trades a day. I do 2 trades a month. Oh, the answer was it's a risk-free investment. So let me just review for you because, again, I'm running out of time. The 3 steps. First of all, you're going to buy or short an underlying security, and you're going to buy a substitute option trading at parity. One of those 2 things. Step 2, you're going to sell a near-term at-the-money option for its premium value, get an instant dividend to profit buffer, and you're going to collar that with a married option that is 3 to 6 months out in expiration to protect your investment. If you're doing this electronically, screenshot this particular slide. Here's the timing of a position. So we talked about timing. I love sideways choppy positions. And basically, we time the symbol so that at the bottom of the sideways choppy channel, that's when we buy the underlying stock or we buy a call option trading at parity, put a stop loss order in place. It's like any normal trade. Then when we get a top signal, sell the near-term call option, buy that protective put option, let that near-term call option expire worthless, roll out the put option when we get the signal, rinse and repeat, rinse and repeat. And again, we didn't talk about covered puts, but basically they flip this upside down. If you're at the top of the channel, that's when you short your stock or you buy a put option trading at parity, same thing. Put your stop loss order in place. Now you're going to sell your near-term put option, buy the 3 to 6 month out call option. This is a daily chart, by the way. Your near-term put option expires worthless. You roll out of your protective call, rinse and repeat. So then you're probably saying, well, how do I know when this sideways choppy option underlying symbol is, when should I do these different trades? Well, this is where I ask, would you like to know how to never miss a pick? Would you like to minimize that amount of time you spend away from your loved ones? Have the support whenever you need it? Because that's what it's all about. And would it be okay if I took a couple minutes to tell you about what I've got? Because the first thing you need to do is get our free indicator. Now, our indicator is set up for Thinkorswim, but we're currently, so if you're using Thinkorswim, that's great, but we're currently getting it converted to all the other types of trading and charting softwares. So even if you don't use Thinkorswim, you should still go to this website, and maybe David will put this into the chat for me. It's tt4.me/indicators. And that'll get you to sign up for free access to our web portal. And what you see when you get that free access to your web portal, you log into the web portal, and there's all sorts of stuff that you can get. You can get a whole bunch of my other tools. You can get a short course on how to sell cash secured puts, all my white papers, a neat risk reward tool. But here's what is kind of neat. You get your indicators right there for free. And this is the free version of the indicators. There's a tutorial, 7-minute tutorial on how to install it and how to use it. and it comes with all of these indicators, and these are the indicators that tell you when to do those individual trades, right? I use these indicators end of day at 10 p.m. at night after my toddler's gone to sleep in order to tell me when to adjust my position by selling premium, buying protection, rolling out of the protection, buying the initial covering position. All of that good stuff just happens right here.